Hello and welcome to Lecture 11. We're going to be discussing pushing exports. This comes from Chapter 11 in your book. Up to this point, we've talked about trade barriers and tariffs on imports. Now we're going to look on the flip side. So rather than looking at the imports, we're going to look at countries that push exports. So let's jump to our first topic, which is dumping. The WTO says dumping occurs when goods are exported at a price less than their normal value, generally meaning they are exported for less than they are sold in the domestic market or at less than full production cost. And so how do countries or companies afford to do this? Well, we're going to look at it, but the concept is called dumping. So there are two legal definitions of normal value. Remember, for dumping, they're selling or exporting at a price that is less than their normal value. And it's typically higher in the domestic market than outside the country. So the first is a price-based dumping. Price-based dumping occurs when a firm sells a product in a foreign market at a price below that for which the firm sells the same product in the domestic market. So basically, they're selling it for less overseas than it is being sold at home. International price discrimination favoring buyers of exports. So this favors buyers of exports. The domestic consumers are being hurt by this. They're paying more than the international price. Then there are cost-based dumping. Cost-based dumping occurs when a firm sells the same good in a foreign market at a price below its average total cost. So these are two different ways we can look at dumping. These are legal definitions. So either price-based dumping or they are cost-based dumping. So price-based, they're selling it below the domestic price. Cost-based is they're selling it below its average total cost. So why would any nation or company want to participate in dumping? First is called predatory dumping. This is when a firm temporarily charges a low price in the foreign export market with the purpose of driving its foreign competitors out of business. That's why it's predatory. So they're trying to destroy their foreign competitors by underselling them at a loss to their own company. Then there's cyclical dumping. This occurs during a period of economic recession. Because of low demand, a firm tends to lower its price to limit the decline in quantity sold. During a recession with falling demand, the market price may fall below the average total cost, but above the average variable cost, covering part of the fixed cost of production. So the firm will continue to produce as long as price exceeds average variable cost. That can't go on forever. That's why we call this cyclical, and it's in times of economic recession. Some additional reasons for dumping: there's seasonal dumping. This is when a firm exports excess inventories of a product. A price above the marginal cost of making the sale is sensible. So this is when they're trying to get rid of last year's model. They'll sell and price or dump their inventories of product to make way for the next seasons. So similar, an introductory low price that an exporting firm uses to establish its product in a new foreign market. So it's just to establish product at times. Then there's persistent dumping. This is when a firm with market power uses international price discrimination between domestic and foreign markets. So in this case, the domestic markets tend to be subsidizing foreign markets. The company can charge a higher price at home, which allows them to charge a lower price abroad. As a general rule, a profit maximizing firm with monopoly power, and that's key, with monopoly power will charge a lower price to foreign buyers if it has less monopoly power in the foreign market than it has in its home market. So they have monopoly power in their home market, but not in the foreign market. So they might do persistent dumping in the foreign market. Or buyers in the home country cannot avoid the high home prices, by buying the good abroad and importing it cheaply. So there's no way for those at home to see the cheaper price internationally, go out and buy it and import it, bring it back home. So that there's no way to avoid the home market price. So in reacting to dumping, what should a dumpee think? So the one that is doing the dumping is a dumper. So what about the dumpee? So what should the dumpee think? Well, the optimal response to dumping will depend on the type of dumping. Is it predatory? Is it cyclical, seasonal, or persistent? Dumping is usually good for the country importing the dumped exports, but two types of dumping could be harmful for the importing country. First is the predatory dumping, which for obvious reasons can be bad when it's successful, but this is probably fairly rare. If it is successful, then the dumping or dumper is able to successfully ruin the businesses of these foreign companies because they're underselling them. Cyclical dumping can be harmful. It could also be termed importing unemployment, but much of the time it's just part of the industry cycle in competitive markets. So it could be bad for the foreign or importing country if it's predatory and possibly cyclical. So there are anti-dumping policies. And how do we determine what is unfair? So the WTO, they have rules that permit countries to retaliate against dumping if dumping injures domestic import competing products. Okay, so the dumpees have the opportunity to retaliate against those that are dumping on their country. If the government in the importing country finds both dumping and injury, the government is permitted to impose an anti-dumping duty. So this is like a tariff. It's an extra tariff equal to the discrepancy, or what we call the dumping margin, between the actual export price and the normal value. And so they can impose this duty or tariff on the dumping country or companies to bring the cost or the price of those up to the normal value. So this is a table, you can find it in your book as well. These are the top 9 initiators of anti-dumping cases. So we've got India, Brazil, Argentina, EU, United States, China, Australia, Pakistan, and Turkey. So we've got the number of cases initiated, 2 different time frames from 1986 to 1990, and then from 2008 to 2012. We can see that the EU and the US participated significantly in those, as well as Australia, a little bit in Turkey. But look at it now, in these later years, 2008 to 2012, India, and the number of cases that they initiated versus some of these other countries. Brazil wasn't too far behind. So the number of anti-dumping measures that are put in place by the dumpee nation, the importing nation, you can see here are 149 from 2008 to 2012. India instituted 149 anti-dumping measures against other countries that were exporting. In June 2013, we can see the number of anti-dumping measures still in effect. 215 in India, followed, actually, United States was the leader in anti-dumping measures. But look at this. This is an interesting statistic, average anti-dumping duty imposed. So the average duty, 77%, that's significant. Argentina, 85%, United States, 89%. So trying to make prices at home more fair, I guess you could call it more fair, for the industries that are producing the same goods as the dumping nations are. So back to the question, what is unfair? Under current anti-dumping policies, we get the following results. The procedure is biased toward finding dumping. The injury test considers only harm to import competing producers. There's no consideration of whether predation or some other source of harm is involved, or if the benefits to consumers of the low priced imports. So the current anti-dumping policies have room for improvement. They only look at harm to import competing producers, but they don't look necessarily at the predatory nature of that, and also they don't necessarily look at the benefit to the importing nations' consumers. So there are some advantages as well. The process is biased toward imposing anti-dumping duties, generally lowering the well-being of the importing country and also world welfare. So they're counterproductive as we look at it as a whole. So there's been 3 proposals for reforms. Number 1, limit anti-dumping actions to situations in which predatory dumping is plausible. Focus on the type of dumping that is most likely to be bad for the world and for the importing country. Number 2 proposal would be to expand the injury standards to require that full weight be given to consumers and users of the product. Shift to injury to national well-being. See, up to this point, it's just injury to the import, the industries, the importing countries' industries in the same product that's being imported. And so in this one, not only look at the businesses that are producing the same product as the product being dumped, but look at how are consumers benefiting. What is the net national well-being? Maybe consumers are benefiting more than the importing country's industry is being hurt. And so we've got to look at that net benefit. Finally, the 3rd proposal is to replace anti-dumping policies with what we call safeguard policy. This is another kind of increased temporary import protection allowed by WTO rules. Okay, so a little on the safeguard policy. It's better because there's no need to show that foreign exporters have done anything unfair. So you don't have to point the finger and say that the foreign exporters are doing something wrong. The interests of consumers can be considered in the process that leads to the decision of whether or not to impose a safeguard policy. So not only do the industries of the importing nations get consideration, but also consumers' interests get consideration. The focus is on providing time for adjustment by the import competing firms and their workers. So it's a temporary measure to allow the import competing firms and their workers to adjust. There's also pressure to adjust because the import protection is temporary. So it tries to get things into a little bit more of an equilibrium, give the import competing firms a little breathing room and an opportunity to adjust the way they're operating. So now let's talk about export subsidies. So before this, we were looking at dumping and different reasons why countries or nations may want to dump. Now let's look at subsidies for exports. Governments promote or subsidize exports more often than they restrict or tax exports. So an export subsidy is controversial because it violates international norms about fair trade. So one nation is trying to make sure that their exporting industries have the upper hand. So export subsidies in a competitive market. An export subsidy expands exports and production of the subsidized product beyond what it would normally be in equilibrium. It lowers the price paid by foreign buyers relative to the price that local consumers pay for that same product. Also, it reduces the net national well-being of the exporting country. So this should be something that policymakers, legislation should take this into account. What is the net national well-being? Often these types of subsidies are just meant to help specific industries and or companies. Okay, so now we're going to look at figure 11.3 in your book. This is export subsidies, and we're assuming this is a small country with an exportable product. So with free trade, the world price of the product is at 100, and you can see at that price, producers or suppliers are going to produce 160, consumers are going to demand 70. So the difference between these two is how much would be exported, which is 19 million steel pipes. We're looking at dollars per pipe, million pipes. So 160 minus 170 is the amount that is exported. So if the country instead offers an export subsidy of $20 per unit exported, there's that $20 per unit exported, revenue per unit exported rises to $120. So then production will slide up to here at $120. Consumption or demand in the domestic market will decrease because of the increase in price. So now we have a new exportable amount from 190 to 50, which is going from previously exporting 90 million pipes, now 140 million pipes. And so our domestic consumption drops from 70 to 50, and the country exports the difference here, as we mentioned. So domestic producers gain in this. They're the winners. They gain surplus areas equal to E, F, and G. This is what the producers gain, E, F, and G. The cost to consumers, they lose area E and F. So consumers used to gain this, and now this is going to the producers. Also, the cost of the government of paying the export subsidy is area F, G, and H. So the net national well-being loss, the loss to the net national well-being because of this export subsidy are areas F and H. So this is the loss, the net loss to the nation because of an export subsidy. Looking at this a little bit more deeply, the consumption effect or the lost consumer surplus for those consumers squeezed out of the market when the domestic price rises above the world price. So when it went from 100 to 120, it rose above the world price, some consumers were squeezed out. And so rather than consuming 70 million, now they're consuming 50 million. That's the consumption effect of the export subsidy. The production effect, the loss due to encouraging domestic production that has a resource cost greater than the world price, the world standard for efficient production. So there's loss there as well. In the previous figure on the prior slide, we saw that a small exporting country harms itself by offering an export subsidy to its competitive exporting industry. So that's small, and the small country was not able to affect the world price by their exports because they're so small that it didn't affect the world price. However, what about a large country? Large countries, if they're going to export enough product, they will affect the world price. They will drive the world price lower. And we're seeing this if you look at section A of figure 11.4 in your book. We've got the original world price. With that original world price, the domestic producers will export 19 million pipe. And they're, again, this is a large country, so they're going to be able to move the world price. And this is actually going to end up making them potentially worse off for large countries than for small countries. So with free trade, we're at $100 per pipe. When the exporting country government offers the export subsidy of $20 per pipe, exporting firms will want to export more to get more of that subsidy. Okay, so there's going to be a $20 subsidy. When they go out to the foreign markets, what will happen is they'll flood the markets with more product, which will drive down the world price. So instead of the world price being at 100, it'll drop to 88. And so the subsidy of $20 will bring the domestic price up to $108. Okay, so they're going to be, the producers will produce at this level 108, which means they're going to produce 172 million pipe. Consumers at that price in the domestic country are only going to consume 62. So 172 minus 62, that means they're going to be exporting 110. Before they were exporting 90 at this equilibrium point of 100, but now they're going to be exporting 110. So you can see here the foreign demand for imports moves out to 110 because the price is down to 88. So we can see this resulting equilibrium of hitting at 88. So the revenue per unit received by the exporting firm is 108, as I mentioned, and domestic buyers pay this price of 108. The net loss of well-being for the exporting country is area F, H, I, J, K, L, and M. That is the net loss of well-being for the exporting country. The export subsidy both distorts domestic production and consumption and worsens the exporting country's international terms of trade. The inefficiency created for the world is area F, H, and U over here. So it makes not only the exporting large country worse off significantly, but also harms the world as well. Now let's take a look at what can happen when a government throws enough money at providing export subsidies. So this shows an export subsidy, how it can turn an importable product into an export. So let's start with the world price. This is before any type of export subsidy. So this is the domestic demand curve, the domestic supply curve, but the world price is at $2 per kilo. And at that price, the demand at $2 per kilo is 120 million kilos of butter. So we're looking at butter here. So the world price is $2 per kilo. At that price, in the domestic country, 120 is going to be demanded. However, at that price, only 40 will be supplied or produced. So if we take 120 minus 40, we can see that this small country imports 80 million kilos of butter. So if instead the country's government offers an export subsidy of $2 per kilo, so that's twice as much as the world price, $2 per kilo brings the new price for producers up $2. It doubles it to 4. So rather than being an importer at this point, they were importing 80 million. Now they turn into an exporter where there's more supply in the domestic country than there is demand. So now they're going to be supplying with this export subsidy 19 million kilos of butter, um, but consumers at that price of $4 are only going to consume 60 million kilos of butter. So the difference between B and C is the amount that would be exported. The country becomes an exporter of 30 million kilos of butter. So the net loss of national well-being is the sum of a production deadweight loss of area F, C, and H. So this triangle, as you can see, FCH, and a consumption deadweight loss of area B, J, and G. So B, J, and G. So that is the net loss of national well-being as a result. So who wins in this case? The exporting industries do. However, our home consumers absolutely lose out, and the government has to pay this subsidy. So it definitely appears to harm the nation overall. So let's take a look at WTO, the WTO's rules on subsidies. The WTO rules divide subsidies into two different types. So subsidies linked directly to exporting are prohibited, except export subsidies used by the lowest income developing countries. So this gives industries of the developing countries a little leg up. Subsidies that are not linked directly to exporting, but still have an impact on exports are what we call actionable. So if an importing country believes that a foreign country is using a prohibited subsidy or an actionable subsidy, the importing country can follow one of two procedures. They can file a complaint with the WTO. They can use a national procedure similar to that used for dumping. If the importing country can show the existence of a prohibited or actionable subsidy and harm to its industry, it is permitted to impose a countervailing duty on those imports. So very similar to what we saw with the dumping case. So should the importing country impose countervailing duties, that will increase the price for the importing country's consumers. So if the exporting country is large enough to influence the world price of the exports, then the export subsidy lowers the price that the importing country pays for these exports. The importing country benefits from improved terms of trade as a result. So a countervailing duty can reverse these effects, but the importing country is worse off. So export subsidies are bad for the world as a whole. So imposing the countervailing duty is good for the world as a whole. And here we can see this in graphic form. This is figure 11.6 in your book. We've got a foreign export subsidy and a countervailing duty. So the diagram shows the effect of a Brazilian export subsidy on steel to Canada and a Canadian countervailing duty on imports of subsidized steel exports from Brazil. An odd pattern results. Each policy in turn brings a net loss to the country adopting it, yet for the world as a whole, the Canadian countervailing duty undoes the harm done by the Brazilian export duty. So we're going to start off with the free trade price of 300. You can see here at this point at the world price, the Canadian market for cold rolled steel, the demand is at 200, and the supply is at 150. So they're going to import 50 million tons of cold rolled steel at that point. The Brazilian government offers a subsidy of $50 per ton exported. So if all of this is passed on to buyers, the export price declines to $250 per ton, as opposed to the 300. Canadian imports increase to 80 million tons. You can see at the lower price, the demand is at 210. The supply decreases as well to 130. So the the amount imported increases to 80 million tons. Canadian production, as I mentioned, declines to 130, and Canadian producers' surplus declines by area V. So the producer surplus gets slashed by area V. Canadian consumption increases to 210, as I mentioned, and Canadian consumer surplus increases by area V, W, Y, and Z. So the consumers gain this area, the producers lose this area. So the net Canadian gain from the Brazilian export subsidy is area W, Y, and Z, because this is a wash between the consumers and producers. Still, Canadian producers are harmed, and they complain about the unfair competition. How can we compete in this market? So for the world, this is too much steel trade. Steel tons that each cost 300 of Brazilian resources to produce are valued at less than 300 per ton. So remember, this is the world price. Now they're valued at 250. What happens if the Canadian government imposes a countervailing duty of $50 per ton of imported steel? The duty inclusive price of imports rises back to 300 in this subsidy plus countervailing duty situation. You can see Canadian demand for imports here goes down from 80 to 50. But then they're going to add a countervailing duty, which will bring it back up to 80, and all is right in the world. So strategic export subsidies could be good under competitive supply and demand conditions. An export subsidy harms the exporting country, but for some industries, the competitive condition assumption does not apply. More on whether or not strategic export subsidies could be good. For a global oligopoly, a strategic export subsidy could benefit the exporting country by shifting more of the high price, high profit foreign sales to its firm. However, the other country could counter with an export subsidy for its firms, in which case both exporting countries would end up worse off. And we often will see this retaliatory approach. So the case for giving the subsidy is very fragile, depending on too many conditions to be a reliable policy prescription. For example, purported high foreign profits may actually turn out to be small. So the policymakers may be tempted, especially when a particular industry wants favorable treatment. Policymakers may be tempted to have export subsidies, but what we've seen is most likely it will harm the well-being of the exporting country and the world. So with that, we've talked about pushing exports and how they're typically not a good idea. If you have any questions about this information, please feel free to shoot me an email, call me during my office hours. I'm happy to chat, and best of luck.